What's up, bro?
What's up? What's up? What's up? Just
I got a little microphone for my computer.
little microphone. You mean better microphone? What?
Well, I was just using the microphone in my laptop,
Okay.
so I got a little plug-in one.
Okay.
I don't
Okay.
know if you can tell a difference or not.
Yes, it sounds less roomy or whatever, like tin candy. So yeah, a
Right.
little bit better. Yeah.
Cool,
Just,
man.
just
It-
give me 1 minute, finishing some stuff, and then we begin.
yeah, take your time, dude.
Okay, I think I'm done. Okay. And I think you muted yourself or something.
Oh yeah, so I got a little button on my
Yeah.
mic that I gotta push, so I
Okay.
forgot about that. But yeah, look at you with your boom microphone up there, bro.
Oh, reinvesting everything back. Like I told you, everything will be reinvested back into the project. YouTube, Patreon, everything will be just back into the whole stuff to increase the quality and everything.
Yeah, man, looks good up there. Looks good.
So yeah, how you doing? How's the portfolio and stuff?
Not good. Not good, bro. I know for sure I lost like over 10%, maybe even more. I put a little bit more money in to buy.
Mm-hmm.
I didn't put a lot in because uh, as a professor in the United States, you work for the government, you're a
Yes.
US employee. So I get paid once a month and it's a month late. So
Mm-hmm.
I teach for 6 weeks at the start of the semester before I get my first paycheck, which is this
Mm-hmm.
Friday.
Mm-hmm.
So of course I'm like waiting on my cash flow and everything's on discount. And so I put a little bit of money though. I had a couple $100 laying around that I was able to get some things on discount. But yeah, I
Mm-hmm.
took a beating this week, man. I took a big old beating, that's for sure.
Okay. Just give me a minute. Someone is calling. Let me answer this. Hello? Okay, all good. Sorry about that. Just appointment confirmation and stuff. So yeah, you got a little bit of dip, you said?
Yeah, I mean, not as much as I wish I could. If I
Mm-hmm.
had more money on hand, I would have been more excited about it. But I do feel good about, I did catch, I think, a little bit of a sale. But yeah, it's always uh so I do website design. There's one client I have to go pick up $500 from,
Mm-hmm.
but we had that snowstorm last week, so I couldn't leave
Yes.
my house. So it's like if I would have not had the storm, I would have had an extra $500 I could have invested this week. So it's like it always I miss the good times, but I stay invested and I didn't freak out and sell nothing. And I even doubled down on some stuff that I was like PayPal, for instance. I bought it pretty high
Mm-hmm.
and I'm down quite a bit. And I just kept buying more because to help average it out better.
That's good. So
Yeah.
yeah, these dips for us or whatever, crashes, corrections, dips, they must not be scary at all for us because like there is no point exiting the market now since we're investing
Right.
20, 30 years more. Just
Right.
opportunity to buy more and stuff and they basically it's simple as that. So my portfolio, I don't know, basically I was seeing everyone is panicking and stuff like blah blah blah, gurus stopped posting their like daily gains and stuff on Instagram. Like, so my portfolio yesterday was like up 1%. Today it's
Nice.
like up 2% or something like this. So power
Yeah,
of
I just checked, man. I'm actually up a little bit today. It started off bad though.
no power of diversification. Basically, yes, it's good to have all these gains. I know, like being heavily exposed to booming sector like technology or anything. But as soon as bad things happen, basically that's what you feel, the absence of diversification. So yeah, good you're recovering, good you bought some dip. So hopefully it will be better, but basically it's nothing to worry about 100%. So yeah.
Yeah, I think we still have a bullish market,
Mhm.
like overall in general right now.
In general, yes, I would say yes. And like so many YouTube people who are basically saying, I don't know, like buy this is the next 500% stock, this and this and that. Like everyone is genius in bull market. Like when everything is growing, it's so easy to say, guys, I just found this super extremely good company. It's gonna explode, and it is exploding because everything is basically gaining and profit and profit and profit. So of course, like the real test of this for these gurus and stuff will be whenever the market is not in such a good condition, like bearish and stuff, recession. This will be the real test for them, what kind of videos they're going to be making at that time when they basically cannot find the next Tesla, the next PayPal, the next Amazon, the next this and that. So let's see. But glad everything is growing, glad everything is good. Still dollar cost averaging. Yesterday dip, I basically, like, because my portfolio was up, I did not have, I think, at least maybe I have like 1-2 company that dipped, but like that's it. The overall portfolio was more or less stable and everything. So I didn't even have opportunities. Even if I was to cheat my dollar cost averaging strategy, there was still no opportunities to buy any stocks with discounts because all of them were less the same good.
That's cool, man. That's good. That's great. I'm
So yes.
definitely like, I was all my stuff got hit hard because I was like in solar,
Mm-hmm.
little EV, the semiconductors, tech.
Mm-hmm.
So they
Mm-hmm.
all got hit hard, but that's definitely where I'm starting. And like, as I have more money and keep investing, I will diversify more and definitely get more safer industries to be in as
Mm-hmm.
well. But since I'm still young, I'm trying to get the growth ones
Mm-hmm.
first, and
Mm-hmm.
then I will continue to uh, start adding safer positions to my portfolio to help out for sure. So
No, obviously knowing if we could have predicted that there'll be such a huge recovery and the fastest bear market with the biggest bull market right
right,
after this, if we could have predicted this, obviously yes, the best strategy would be to just invest in only growth companies, get this massive triple digit gains, and then basically switch to more like conservative and dividend paying companies. But like I said, it was the fastest bear market in the history of the stock market. No one could have seen it. And even though the market's already even higher than 1 year ago, the world is still not like it was 1 year ago. So let's see. I am just, like I said, diversifying different sectors, different industries. I'm more or less satisfied with the portfolio. Heard seeing everyone is flexing their Teslas and whatever other companies they're flexing all the time, but that's okay. So yeah, I don't think
good.
anyone.
We gonna we're starting to do the vaccine at my school,
Mm-hmm.
which is good. They're starting.
Mandatory vaccination or no? Just
I'm not sure. It might be up to you, but I'm definitely gonna get it. That's for sure.
okay. And so today, do you have class today, or it's snowstorm
Yeah,
and no
yeah.
roads are blocked?
I'll have to roll at 2, so we can get started if
Okay.
you want.
Yes. Let's do it then. That's what I'm asking. Okay. So investment horizons. Today is the topic. Pretty self-explanatory. Pretty easy. Just a second. Where is this? To pin this. Okay. So yeah, investment horizons. Today's self-explanatory topic. Um, these are the whatever it's called, how it's called. Topics for today. How long should you invest for short-term portfolio, medium, long-term portfolio, portfolio distribution formula? Sounds scary, but it is. You probably even have heard about this so-called formula. Then overconfidence is bad, and as always, questions and answers in the end. Okay, so how long should you invest for? Start investing obviously as soon as possible. It is never too late to begin. The younger you are, the longer you should plan to invest. You can even invest for several months if you want, and don't be tempted to catch up by making risky investments. So one by one, basically. It is never too late to begin. Compound interest starts working, I think, like what, in 10, 15 years, the compound interest starts basically demonstrating its true power. So even if you're 40, in 10 years, you'll be 50. So majority of people are investing until retirement, until like 60, 65. And when you're starting at 40, people think, okay, it's 40 and it's too late to invest. At 50, you will already start experiencing compound interest, and you still have 10 more years after this. So of course, it's never too late to begin. The younger you are, the longer you need to invest. Also basically self-explanatory stuff, because compound interest, as soon as starts compounding, every single year after this, it's going to be just crazy. You know, all these compound interest graphs, how they look like. It's slow, slow, slow in the beginning, then starts basically inclining, and in the end, it's just basically steep, almost like 90 degrees, like slope, just all the way up, long story short. And you can never invest for several, you can even invest for several months if you want. Obviously, you don't expect massive gains or anything like this, unless you're extremely lucky and you just want to gamble, put all your money in some penny stock, then yes. But it's just literally pure gamble. It's the same chances of discovering such stocks, the same as going to casino, playing roulette, betting on one single number, and just multiplying your original bet like 35 times. Same chances. But if you have like substantial amount of money to invest, I don't know, like $100,000, and you need maybe a couple of thousand or something just for whatever reason you need this, you can basically invest in some blue chip companies, ETFs or anything like this. You can get your couple of $1,000s. I think it's not a big deal, not a problem at all. And obviously, don't be tempted to catch up by making risky investments. This is the worst thing you can do. Whenever you already, so this comes back to our second point. The younger you are, the longer you should plan to invest. So whenever you're already like, not saying old, but whenever you're older, whenever like 40, 50, and you might think, okay, let's start investing, but I only have 10 years to invest. And you, as you might know, the longer you can invest, the riskier you can be. And the shorter you can invest, the the less risky you should be. So in this case, when you're 50 already and you're trying to catch up by making risky investments, so you're doing absolutely everything wrong, let's say so. You have short investment horizons and you're making risky investments. In case anything goes bad, and it can go bad, it can really go bad, you can lose like half of your portfolio value in less than a year. You will most likely don't have too much time to recover. And even if you can recover, you can basically come back to square one. You can just make all the money back that you just lost. And 10 years of investing, you're just basically at the same starting point. So at this time, don't be tempted to catch up. Just make some ETF investments, VTI, VOO, maybe some bonds, because you already have like 10, 15 years left. But don't be tempted to catch up by making risky investments. This is the worst thing you can do, definitely. Okay, so if you have any questions, I'll just start talking.
I do have one. It's slightly unrelated.
Mm-hmm.
You did the Apple thing yesterday, right?
Yes.
So what did they raise the dividend to?
They didn't say it yet. They
Okay.
just said we are planning, yes, to basically keep increasing dividends. So that's all they said. And yes, I think they have all the possibilities to do so. I guess you heard about how much cash reserves they have, how much retained earnings they have. It's basically a massive pile of cash. So I think they are safe to increase dividends basically. I'm not expecting obviously to increase the dividends like double digits or anything like this. And of course, I do not even want this, even though it's always tempting to have good, nice dividends. But this is a technological company which better use this money in research and development.
For sure.
So they haven't said, or at least I missed it, but I was just watching it also. I think they just haven't said. They just mentioned that they are planning to keep increasing dividends basically for as long as possible, but they haven't said until what dollar amount they're going to do it. So let's see.
Was it all about finance, or did they talk about any product?
The whole presentation was basically a combination of this, I would say. Financial aspects they just mentioned maybe in the very beginning, like our biggest quarter, blah, 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 or like sales per year increased by 6%, if I'm not mistaken, this and this and that. And then they started basically talking about like, I don't know, like even life stories. There was some representative of African American community, the girl who was the first one to go into white school or something like this. She was talking about this, and this was basically, I don't remember, just just life stories using the she was using the, how it's called, Apple Watch. She was on the run or walk or something like this. So basically she was just sharing this. It was something like go to some exercises to reflect on yourself kind of section of the presentation, something like this. So yes, and then in the end there was just basically Q&A section, and team was answering basically the least expected questions. So instead of answering stuff about Apple Car, instead of answering about, I don't know, what are the new iPhones not gonna be and stuff like this, he was just basically answering like kind of a little bit irrelevant stuff, but basically that's okay. More or less nice presentation. I got copyrighted, so I have one out of 3 copyright strikes on my YouTube channel already. But I had all the way up to 85 viewers. This was just literally, I was not expecting this. I was like, my channel is like 3,500 subs, something like this right now. But majority of those, like 3,100, I would say, these are the people from the past. I had my Rubik's Cube tutorial videos basically in the past, blah, 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 this and that. So originally, since I started this channel, maybe since August or something, I only have 400 subs. And I was doing just basic calculations based on Meet Kevin and all these people who are doing lives. Usually about 2-3% of your audience is watching your lives. So, and 2% of 400 is like 8 people. And I had 85. It was like literally mind-blowing, to say the least. But yeah, in the very end, when I started already talking about the market crash of yesterday, I got like copyright strike and this and that. And okay, whatever. It expires in 90 days. So it's okay. Okay, so next one, since you in a rush, and why not continue, I guess, unless you have any questions. Short-term portfolio. Okay. Short-term portfolio. Recommended to be assembled from mostly fixed income securities. Do not expect high returns, obviously, unless you get lucky. And it's easier to lose money in short term than to make big returns. Obviously, first of all, is to have it mostly of fixed income securities, such as bonds, treasuries. Yes, you will not have anything crazy. I don't know, like maybe 3-5% return, annual return. But if it is your short-term portfolio, because everyone starts with long-term portfolio, especially they start in the young age. Right now, our long-term portfolio is like 30 years. But eventually, when we get closer to retirement, our investment journey will only have 5 years left. And this is already short-term portfolio, which means that you better to switch to fixed income securities. And even though it's like 5%, and imagine if your portfolio at this time already reached $1 million mark. So 5% on 1 million, it's $50,000 coupon payments per year. This is literally average salary that you just get from coupon payments. And I'm saying about $1 million. This is like absolutely extremely realistic scenario if person is investing for 30-35 years. I would even say portfolios can be up to $2, $3, $4 even million, which basically means that just coupon payments, just 5% coupon bonds will give you like what, almost $200,000 in coupon payments. It's just incredible. So like I said, don't expect high returns. So market is growing like what, 8, 9, 10% per year. And if you have the same $1 million portfolio, this will be like $100,000 per year. I would say this is more or less guaranteed. No, as much as I can guarantee it, it is guaranteed. So, but coupon payments will be twice less, but still it's very, very decent money. And the most important thing, it guarantees the safety of your principal. You've been investing for 35 years. Obviously, you do not want to lose a third of it in like a couple of months because something bad happened and then just panic sell everything. You just locked in 70% of your portfolio, which means that you literally lost like 10 years of progress or like 15 years of progress in a couple of months. So obviously it's better just not to get greedy, get fixed income securities, live on these coupon payments, and that's as simple as that. And it is easier to lose money in short term than to make big returns. So obviously this comes down to risky investments. If you are not investing in risky investments, if your portfolio is not risky at all, and if you're just making like bonds investments, fixed income securities, you will not get obviously too like massive returns or anything like this. But if you switch to riskier investments, the riskier your portfolio is, the higher are the chances that something will go wrong. So this is where it comes from, basically. Okay, so the next one, unless you have any questions, is medium-term portfolio. Medium-term portfolio can be a combination of fixed income securities and equities. Balance should be based on your risk tolerance and investment horizons. The very basic explanation of this is that if you are feeling that you can tolerate more risk, you can have more equities. If your investment horizons are long, like 20, 15 years, you can also have more equities. But if you are not a risk-taking person, if your medium-term portfolio is about to become short-term portfolio, just switch mainly to fixed income securities and no one restricts you from having equities. Hopefully this will be like ETFs or anything like this, like better to play it safe, safe than sorry, better safe than sorry, better long, how it's called, slow and steady wins the race. And compound interest starts truly working, like already mentioned, in 10, 15 years. And you can still start medium-term portfolio even if you're 50 plus. That's what I was saying in the very beginning. If you're a 50 and you're like, okay, it's too late to invest, but you can still have medium-term portfolio because at the very, just before you're about to retire, this is when the compound interest starts truly working. Of course, it will be better if you have started investing earlier, so you can enjoy the wonders of compound interest previously, before you're about to retire. But still, it's never too late to invest, coming back basically from my first slide. Okay, so unless you have any questions, the next one is long-term portfolio. Okay, long-term portfolio can be comprised mostly of equities. You have enough time to mitigate the majority of risks. If anything goes bad, bear markets are usually not longer than a couple of years, I guess I would say. And because in our age, the trading, investing gets so easy. Everyone has apps, Robinhood, Wealthsimple, whatever it is. Like it just gets so easy to trade. So that's why I think personally, bull markets and bear markets, they become faster. So in the past, whenever it's the bear market, there was like no social media, there was no YouTube when financial YouTubers were pumping stocks, buy Palantir, buy this, buy that, buy that. So at that time, people were truly afraid, and it took them some time to recover and start trusting the stock market again. Besides that, they didn't have any Robinhoods or anything like this. They actually had to call a person and okay, let's start investing back again. Right now, everything crashed. You start watching videos by YouTubers who are saying everything is crashing, sell everything, so it accelerates the crash. And then the same YouTubers start, okay, economy is recovering, buy Palantir, buy Tesla, buy this, buy that, buy Apple, and you start buying and the economy starts recovering faster. So I think because of this technological progress that we're having, the bull markets and bear markets, the length of these markets is decreasing. So in the past, it was like 2, 3, 4 years maybe. Right now, I think none of this will be more than 1 year, and in between we'll have like more or less stable kind of, I guess, market, which is not going to be explosive. It's not going to be drastically down or anything like this. But the markets in themselves, I think they will be faster. So long-term portfolio can be dividend or growth oriented or both. Dividend portfolio, basically you receive lots of dividends, you try to achieve higher dividend yield than S&P 500 dividend yield, which is at this very moment, I think, a little bit less than 2%. So I think dividend portfolio with the dividend yield of around 4 or 5%, I would say 4%, it's pretty decent portfolio that anyone can assemble of pretty good and trustworthy and strong companies, such as AT&T, 3M, Johnson & Johnson. These are all the companies that are pretty strong, paying good dividends. Coca-Cola, obviously. You can just assemble a portfolio of these companies, receive dividends. Do not expect too much growth, obviously, of these companies. But if you reinvest all these dividends back into your portfolio, to the stock market, this is what's gonna basically substitute the growth that the growth investments provide to you. Second can be growth-oriented portfolio, basically what's most popular at this very moment when you buy companies that are basically not profitable, but they're promising huge returns in the future. Some of them might be able to do it to justify their promises. Some of them might be not be able to justify their promises. Time will show. So you are betting basically, and this is where it comes from: more risk, more potential return. So you trust those people, you trust those management of the companies who are saying that even though right now we do not make money, but 5 years from now we're gonna take massive part of the market for, I don't know, electric vehicles, and you are basically investing just in their promises. So let's see how it's goes. Or it can be combination, which can be a little bit of growth companies, a little bit of dividend companies, a little bit of this, a little bit of that. And this is what I am finding that works good for me for now. I started as pure dividend value investor, but I started this at the very beginning of the recovery, like in the beginning of May 2020, when the market's already in the middle of recovery. So I should have started with the growth companies. I'm thinking that now, but like I said, I couldn't have known that the recovery is going to be so fast. So I bought some cheap dividends. I had pretty high dividend yield, like on average, I think it was 5 something percent. Obviously, everything was reinvested back. And now, since like 3-4 months ago or something like this, I'm adding growth companies to my portfolio, such as Corsair, renewable energy. And I think these are just an ARK investment, ARK obviously, if it can be considered as a growth company. And the best that the world of investing has to offer is accessible through long-term investing, obviously. Compound interest, once again, reinvesting dividends, building massive portfolio doesn't take much to do it. It's very easy, not complicated at all. Anyone can and anyone should do it. Everything the best that, once again, the world of investing has to offer is accessible through long-term investing. Though it is never too late to start investing. Even if you have 5-10 years left, you can still invest and get a couple of $1,000s extra. It's never, these couple of thousand are never extra. So just invest and be done with this. Simple as that. Okay. Okay, unless you have any questions, let's go quickly through this portfolio distribution formula. Okay, the formula is very simple. Like I told you, is basically 100 minus your age. The number that you get is the percentage you can hold in equities. The rest is in fixed income securities. So if you're 30, you can have 100 minus 30. You can have 70% in equities and no stocks, obviously, ETFs, and 30% in bonds. And whenever you're already 60, this is when you already start switching. Basically, you have like 40% in stocks, 60% in bonds. Basically, you see what's happening here. The closer you're getting to retirement, the closer you're getting to the end of your investing journey, the more conservative your portfolio becomes, the more safe it becomes. So basically, whatever you made throughout your whole investing journey, you start saving it, you start being more cautious about, and there are less and less chances of losing significant portion of your portfolio just if something bad happens. And basically, yes, that's what I just told you. The older you get, the more fixed income oriented your portfolio becomes, which means basically more safety. Simple as that, very simple formula. I guess you heard about it. Okay. Unless you have any questions, let's continue. The next one is overconfidence is bad. You might get tempted along the way of your investment journey and start trading. The longer you trade successfully, the more confident you get. The more confident you are, the riskier are the trades. And basically, the riskier are the trades. It takes just one trade for everything to mess everything up. So you start as an investor, for example. Even if you want to be a trader in the stock market, like some people, obviously, they unfortunately do not know even the difference between investing and trading. But still, if you are confident that you want to start trading, not investing, it means that you want to buy and sell shares to extract profits from price volatility and stuff like this. Even if you know that you're going to be trading, in the very beginning, you are 100% going to be cautious. You're not going to start trading immediately with like 20 margin or 100 times margin. You're going to put like $100, $200. You're going to be extremely cautious. You're going to put $200. As soon as you make like $20, you're going to take the profit. As soon as you lose $10, you're going to exit the position. You're going to be extremely cautious, even if you know that you are going to be trading. And the longer you trade successfully, the more confident you get. So you made $20 here, $40 there, $50 here again. Next month you already start making $100 per day. Half year from now you're gonna start making $500 per day, and you start increasing the deposit amount. Like you start with $100, now you're gonna be trading $5,000. Then you're gonna start using margin, like 10 times margin. I don't know how they're called in English. I guess 10 times margin. Whenever you're like using 5,000 of your money and $50,000 of margin account money. And these things, they amplify obviously your returns, profits, and they amplify your losses. So if you're extremely lucky and you're trading successfully for 3 years, in the end, you're going to be trading like $80,000 at once. And for you, it's not going to be a big deal. And then imagine like $80,000 on 10x margin, which means that basically you're using like, I don't know what, like $70,000-$80,000 of leveraged money. And then if anything goes bad and you lose this whole money, you lose your initial whole deposit. And then you need to owe bank like $70,000-$80,000 just because of one trade. And obviously trading is like some traders, they're like, even though they're like to gamble, they like to take risky stuff, they still being very cautious about locking in their profits. They take money out of the market, they put the bank accounts, and then they just spend the money like everyone else, groceries, I don't know, like clothes, rent, and stuff like this. But some traders, when they start becoming extremely successful, making $1,000 per month, they obviously start increasing the more money you make, the more money you spend. They start. So they start buying, I don't know, expensive cars, Lamborghinis, Rolex, and all this kind of stuff. So literally everything you make, you basically buy expensive things just to, I don't know, maybe you start even selling courses on Instagram, trade with me, you know what I'm talking about. Even though 90% of these traders, they do not have all this money that they're showing on Instagram. Usually these are rented Lamborghinis, like rented Rolexes and stuff like this, but not going to talk about this at this very moment. So they start spending more. They start spending majority of their income, even though they're successful traders. And whenever you have almost no money in savings and you are making like $80,000, $100,000 trades on a daily basis, one trade goes bad, and that's it. You're in $80,000 debt just because of one debt. So that's what I'm saying. The riskier the trades, the more confident you become. And never mix investing and trading. Like I said, all it takes is just one bad trade. If you're investor, if you started as an investor and then you're like, okay, I already know how to buy and sell shares. I already know how to do stop loss order. Let me try trading. Never mix it. Even if you want to try trading, it is very highly suggestible to just open another account where you put this money and consider this as a gambling money. Consider this money that if you lose them, majority of them, you're not gonna like take money out of your investing account and deposit this into trading just to like, okay, I know I can get them back. Like, you know, all these gamblers and casino, when they lose money and they're like bringing more money because I know I'm gonna win now and I'm gonna win everything back. So this is what starts basically the process of decay, process of decomposition of you as a trader, what starts ruining you as an investor. So never mix. If you want, start another account, play around, consider this money is gone. If you make money, good. If you lose money, never sell something from your investment portfolio just to be like, okay, I'm gonna make money next trade 100%. Worst case scenario. And I guess that's it. Yes. Okay.
It's good advice. Good advice for sure. There's Think or Swim from TD Ameritrade,
Mm-hmm.
and it's like a trading tool, and they allow you to have a paper money account, and I think
Yes.
that's I should definitely try that first.
Paper trading. Yes.
Yeah.
And
So I feel like I'll find out real quick if I'm up for it or not. You know what I'm saying?
Yes, and I just speaking about paper trading. Yesterday I recorded a video about paper trading for my YouTube, so it's going to be up, I guess, today or tomorrow. I don't remember, so I don't know if you're watching them or not. You can see.
I'll check it out. Yeah.
Yeah. So yeah, paper trading is a nice to begin with and to see, like, to test your strategies. Like some people who don't even know how stock market works, for them paper trading can be good for simply buying and selling shares just to see how it looks. But yes, mainly paper trading is used just for testing strategies, testing like support resistant levels, how they work, and like how good you can be as a trader. But still, paper trading never teaches you how to react when your real money is lost. Paper trading, okay, your portfolio is minus 20%, minus $200,000. Not a big deal. It's not real money. But as soon as you start $1,000 account and you lost $200, that's it. This $200 feels way different. So that's what I'm saying. But yeah, you can try think or swim. You can try paper trading. No one restricts you from this. Just let me know how is it after this. But don't be too tempted to become trader. So that's it for today, I guess. Unless you have something else you want to discuss.
Nice, man. No, thank you. I enjoyed the lesson today, no doubt.
Okay, thanks so much.
It was really good. I'm glad your portfolio didn't totally go off the cliff.
No, thanks.
I opened up a little bit more on PayPal. I got some of that dip, and then I started DCA into Google. Start getting a little bit of them in my portfolio as well.
I also want to open, maybe whenever, if you remember right now, I have like 13 companies, but my goal is to have 23 for no reason except that it's my just favorite number. And whenever I'm extending to 23, I want to add Amazon, Google, because right now they're a little bit too expensive, and Simple doesn't allow fractional shares. But these are the companies that I think I will add. Let's see, or at least maybe one of them. We'll see how it goes.
Yeah, I feel like in America, we're very blessed to get these stock slices and these fractional shares, man. I talk to a lot of people across, the world, and they're like, I wish I could get a fractional share of Apple and all this. And I'm like, it's just a very nice thing to have. And a lot of people in America probably don't even know that this is an option, But my wife, she happened to get 2 shares of Amazon last year. So we got 2 of those, and I'm probably only going to try to get maybe like a half share of Google right now, because they are pretty expensive. They're like $2,000. Yes. So exactly. I'm trying to put like 1,000 in and at least have half of one for now. That's my goal. So
yes. No, we have fractional shares in Canada. It's just my broker doesn't have it, and I do not want right now to buy any other companies. So right now I'm more than satisfied with whatever I'm having. But later, yes, whenever I'm increasing to 23, I might do it. But for now, I'm basically more than happy with this.
That's cool. So where are you at right now? You have 14, or how many you have?
13. 12 companies and 1 ETF, ARC ETF.
Nice. So yeah, I have a 4 ETF, and then I have Apple, and then I'm doing PayPal and Google right now, and then my wife has Amazon and ETF as well. So combined, we only have 3 or 4 single companies, but I'm trying to get to like around 12 to 14 right now is my goal. So, but I'm going slow. I'm picking them slowly, and I'm gonna just build my position slowly over time, and then add new ones as I see good opportunities. So
don't rush. It's better to have everything good since the beginning rather than make mistakes in the beginning and basically make yourself a bad start. Put yourself a bad start. So doing good.
Man, enjoy your Wednesday, all right?
Of course, and you, good luck in your class. Good luck snowstorm driving.
We got 60 degrees or so today. Pretty nice.
Sounds good. Yep. Okay, yes, good. Good luck in your class. Enjoy also your Wednesday. Ask any questions on my Patreon if you have any Q&A section like last time you asked me.
Will do.
And see you next week.
All right. Okay. Sounds good, my man.
Talk to you on Instagram as well. Bye.